Afternoon, evening, everybody. Thanks for coming. We wanted to keep this small, intimate, because it's a great opportunity. I've known Duncan for going on 15 years. We were working together as agents when we first met. We both progressed to broker licenses, and then he took it a lot further as far as administration. The reason to get you guys together is I've talked to some of you, and some of you talked to me about private lending. And it's getting tougher and tougher for mortgage brokers and lenders to reach out to private lenders with all the new conditions and rules from FSRA coming down, so Financial Service Regulatory Area Authority. So what we wanted to do is show you a better way, an easier way to invest your funds, basically almost with guaranteed returns, the safest you're going to get, right?
It's a good bro. Almost 100% maybe guaranteed.
Or 6% of the time, every time.
So what's happening in the industry is there's a lot of concerns with the money laundering and private lending, the restrictions, the looseness of how people are lending their private money. So how it works right now, guys, you say, hey, Mike, I got 500 or 600 grand, throw me on a house, fingers crossed they pay it. We got to get them out. There's going to be some issues. Do we do everything properly? And it just becomes a mess. And administrative wise, a lot of you guys or a lot of the people I've talked to don't have the back end stuff to administer and keep on this kind of thing. So with the mortgage investment corporations, the mix, they're becoming more and more popular. It's a lot safer again because you're putting your funds into one investment and it's being underwritten and taken care of. The biggest thing I like about the mix compared to private lending is the relationship they have with the government. So they're being audited, they have a relationship with the government, there's no funny business going on, it's completely legit and on the up and up. So these guys are scrutinized, I want to say as much as a bank, if not worse, because of the areas that they're lending in and the clients they're lending to. More importantly, these guys are protecting not only clients that are borrowing, they're protecting your investments. They're obligated to make sure you understand what you're getting into, the risks involved, and so it's clear as day to say, it's not just, hey guys, give me 500 grand, I'll get you 12%, we're all good. There's a lot of more obligations on both ends to make sure everybody understands what they're getting into. So again, Duncan has taken the extreme to continue past broker. I was good at being a broker, that's enough for me. He's gone above administration, which is a lot more details, a lot more paperwork, a lot more stuff to do with the government. So he's gonna be able to explain this a lot better, because right now all I do, guys, is I take your funds, we go to the private lender, we use a lawyer, and we lend it out. It works. It's not the best way to do things. This is a much better way to do things. So having said that, I'll let Duncan explain this in a much better way, in a more detailed way that you guys understand what you're getting into.
Thank you for that introduction, Mike. My name is Duncan Wilson. I would go into a lot of history here, and I did talk to Carl even before we showed up here, but I am a more of an optimistic view of the market. If you guys want to hear other opinions, there is other opinions there, but I kind of want to just explain what's happening in the market. I am going to go through some slides quickly. We're going to explain what a MIC is. It's a mortgage investment corporation, but how does it operate? How is it different than anything you guys have seen? I don't know if you know about in the news right now, there is massive uploads in the mix, meaning CMI is a big MIC in Toronto. I'm going to go into all that. I'm also going to explain the risks inherent with a MIC, how they're kind of mitigated. I don't know if a lot of you guys are doing private lending already. This is private lending to individuals that cannot get prime lending. All right. Now, lo and behold, we have a lot less borrowers today because the prime rate just went down 50 beeps. So we might not have as many borrowers. So first slide is that's us four. For me to sit here and tell you I run a MIC by myself, it's almost impossible. To do everything behind the scenes. We have underwriters, that's Sean and Tyler. Yeah, throw your hands up, say hello. Hey. And we also have Charlene, our secretary treasurer. She does the job that honestly impeccable. I couldn't do. I like selling. I like being in front of you guys, explaining what we actually do and how we do it. So to go into the history of this, the reason why this came about, Mike Brain mentioned it. I was a mortgage broker, started off as a mortgage agent. If we want to go way, way back, I sold mutual funds at the bank branch. I sold mutual funds after getting my MFDA license from the branch on a quasi-learned situation where they said, okay, you can sell mutual funds now. And all they do is make you sell this thing called a dividend fund. And for 3, maybe 4 years, I sold these funds not even knowing what was in them. Like, I had no idea. But that's a mutual fund. I'm going to try and give you guys comparisons into that. But going through the brokering system, you eventually come into contact with private lenders. We had a big private lender for years that used to do private lending, willy-nilly private lending. He used to come into us with borrowers 3 months late on his payments. So what I said was, with the brokering license, I said, why don't we run an administration license? So once you get an administration license, you're an administrator, meaning you can help that private lender deal with their mortgage payments, control property taxes, and control property insurance. So with private lending, a lot of times, and I know some of you guys do some private lending, you like looking at the deal. You like looking at maybe a risky deal and saying, okay, let's see if this sinks or floats, or let's see what happens with it. We administer those loans so it actually is a little bit quicker. We're an assist in your private lending where we go to just one individual. When you look at a MIC though, the next step, the next evolution of administration is, wow, we have all these really pretty good loans. We have 30% loan to values. We have people that can actually afford this payment based on their affordability. Where should we put that? We don't want to go to the individual that charges maybe 12, 13%. We want to maybe put that into a MIC where a ton of investors, where investors are like-minded, say, okay, I want an asset-backed security. And what they do is they put their money in this mortgage investment corporation, and the minute we lend it out, the risk is spread across all investors. So if you had 1,000 homes in the MIC, which we don't have yet, but if you had 1,000 homes in there, your investment for 50,000 would be spread across all 1,000 homes. Now what this does is it kind of mitigates the risk of the whole investment. I'll go into that as well. So this is the history. I brought on Sean and Tyler, and I'll be honest, it's been a blessing since. I handed my book over in the beginning. They trained really well. They got better than me at running mortgages, to be honest. Like I was more, what's the next step? What's the next step? So these guys taking my book, I said, let's go start an administration company. Bringing them on, they had the underwriting ability. They definitely had the bookkeeping ability, Charlene. And I said, we can actually do this together. So this is not just a willy-nilly me going, hey man, guys, we don't know much. Let's go start something and get it going. No, this was like a dedicated decision. It took a year to get an administration license from FSRA at the time. And it was a lot of work in order to get it and a lot of compliance orders. Now, when Mike talks about compliance, FSRA is involved on administration side, and on the MIC side is the Ontario Securities Commission. So when we talk about funny stuff, when I talked to Carl, I went deep diving into all this other information that happened. We can look at the scams that have happened in the past. I actually don't know how these guys got around the reporting. I don't know how they actually did what they did. It's incredible that they did that. And it's honestly not looking at the end result as well. So that's the history of our team. It's a dedicated team and bringing in more and more clientele. On the broker side, we have a ton of borrowers, guys. There's 16,000 borrowers in our database. We also market on Google Ads on the brokering side to pull in borrowers constantly. There's about one borrower a day that hits our website and comes into our office. That borrower then needs to be told, you cannot go prime lending. You did not claim enough income. So now we need an alternative solution for that. And this presentation is to talk about that and show you guys the investment behind it. So what is a MIC? A MIC is formally a mortgage investment corporation. Is an investment vehicle that uses both registered cash funds, TFSAs, LIRAs, spousal RSPs, or just corporate cash accounts. So when they first began, it was the government's idea of saying, why don't we create a tax incentive corporation that allows more people to borrow more money and allow them to get into home ownership, okay? Because at the end of the day, that's what this is about. It's giving someone the option saying, okay, you're really bad right now, but in a year from now, we can get you into a proper lending bank, things like that, okay? How are MICs structured? MICs are structured as flow-through entity. So here's the biggest thing I need you to understand. A MIC is structured in essence, if us four wanted to go start a mortgage investment corporation, or just an investment corporation, not a mortgage investment, not a MIC through OSC, we could just, all of us, put $1 million into a mortgage corporation and issue that corporation, start lending it out. The only issue with it is there's corporate income taxes associated. So the minute I turn around and I say, okay, guys, give me all your money, put it in my corp, or here's a promissory note, here's an IOU, okay? It's a big one. You'll get income tax associated with it. So I'm telling you 8.25% return, but you're not gonna get that. You're gonna get taxed first at the corporate level, then taxed again in your hands. With a MIC being investment structure, what happens is it's actually a flow through. This actual corporation needs to net down to zero at the end of the year. All assets have to be pushed out of it to the investor. Meaning when we're talking 8.25% return, you're getting 8.25% return. CRA is not involved on that tax. Now, again, starting in the 70s, why are we in 2024 now discussing this? Because my brilliant mind, along with the administration that I wanted to create an administration. But Tyler and Sean, who chatted in their offices, and I don't know when it happened, you guys could probably tell that to the group, but they wanted to start it. We went around and looked for MICs to manage with our administration because we knew we were good at administering private mortgages. There's MICs just slammed the door in our face. We don't want to be managed by it. So we created our own MIC. And we'll talk about that, the investment behind it as well.
I'll jump in.
Sean's going to jump in, man. I don't talk too much. Sean,
Okay. So our goal with our MIC is primarily capital preservation and ensuring that the capital that is invested is working for our investors. Because essentially, if the money's not lent out and not generating revenue, we don't get paid, you don't get paid. It's not really a win for everybody. So primarily the MIC earns revenue by interest income from interest payments made by borrowers that we collect on your behalf and then remit those dividends back to you. Tyler and I, we were working back in our earlier career and we were getting these loans in and we were going everywhere with them. We would say, hey, to all these Toronto companies, will you lend on this file? It's a fairly decent file. You know, there's affordability here. Your collateral's good. Your risk is low. And they'll say, no, we don't want to deal with Windsor. We don't like Windsor. We don't want to look in that market. It's not something we're interested in. We realize that this market does need something that's a bit more of an affordable option for borrowers as well as generating a return for our investors. And it gives us that option that, you know, if somebody else in the area wants to look at funding a mortgage with us, you know, we're able to not have to go to these Toronto companies that gouge the borrowers and charge exorbitant amounts. And then the money flows out of Windsor into Toronto, which we want to keep a lot of our money in Windsor market. So you might ask, you know, what do we do with your money? What are we doing? So our role is essentially a full service corporation from start to finish, looking at initially ingesting the deal, bringing it in from our own brokerage as well as other brokers in the area. We then underwrite the file. So we do have underwriting guidelines and policies that are based on industry standard metrics. So we'll look at things like affordability of the borrower. We'll look at loan to value of the collateral. We'll look at their credit. We'll look at their capacity. And the biggest thing we always look at is what is the exit strategy? And Doug and I were talking earlier today, and there's some stats here that a lot of the, you know, time previous to 2020, more and more borrowers were able to refinance out with institutions.
Yeah.
And recently, as of 2022, a lot of these borrowers, their main exit is just a sale of a property. And that is heightened because we want to make sure that there is an option that this borrower might be able to get a new loan to pay us out with these funds. So exit strategy is a big item that we make sure we look at. And we don't want to be forced in a situation where we have to force a power sale by the borrower because, you know, that's the higher risk. When we look at a file, we'll look at maximum loan to value, so of 80% of the value, which gives a 20% window that if there is start to be fees that are accruing, interest that's accruing, there is that buffer. We like to say a little bit more conservative around the 75% mark. We'll look at first mortgages and second mortgages. So, you know, we'll typically like a first mortgage with a lower loan to value or a second behind an institution. We do this because when we look at an institution that has a first mortgage, our security grows every time that borrower makes a payment on that first mortgage because they reduce the amount owing to that first lender. We look at credit. We don't want borrowers with 450 credit scores, 500 credit scores. We want them to have some proof that they can make their payments. And we do want affordability because like we said before, if they're not making their payments, then it's in nobody's benefit right there. So that's where we'll step in. And if we find a file that is suitable for our fund, for the fund for our investors, we will continue to process and fund that mortgage. From there, we'll ensure that payments are collected monthly. If the payments are any time delinquent, we'll ensure that we're, you know, approaching those borrowers, where are these payments at, following up with them. Insurance is another big one that we've seen. Borrowers can simply cancel their insurance in the process. And sometimes it takes time for the investor to be able to be identified of that risk. And we don't want a situation where, you know, we find out that a property was canceled insurance 2 weeks ago and it's now burned to the ground, affecting everybody's security. So in that sense, if you're only on that one property and that insurance wasn't upheld, you would be at risk in that scenario. So we do a lot of these things because our goal is to preserve capital and make sure that our investors are not losing their funds and getting that return that we are targeting for them. Basically, our target return right now at the MIC is 8.25%. That compounds every month. So every return that you get is then used at the end of the month to buy more shares. The way that we have been achieving this so far, it's been 3 months now that we've achieved this every month. We collect payment on the 1st of every month. 15th of every month is when we issue it to the MIC, and then that is then converted into shares, and then your security grows. Sean kind of touched on it a little bit, but if we do have any issues with the first month payment, if there's any NSFs, we have that 15-day window to then go after the borrowers in the SHAR to make sure that we can recapture that. DRIP program, so that's the dividend reinvestment every month that your investment is growing. And then at the end of the year and in June, if there is a surplus, that's all given back to the investors. Like Duncan kind of touched on, MICs are fully flow-through investments. So if there is more than that 8.25 made, that all gets pushed out to the investors. Oh, here's a chart that shows what that would look like.
Yes.
So yeah, you start with 50 grand and you let that accrue over 20 years, you're 250,000 after 20 years.
What if the 8.25 is not net?
So if for whatever reason we're having issues with repayment, then it fluctuates downwards. So let's say that there's a chunk of the portfolio that's not performing, there's a few mortgages that aren't doing well, and we're in the middle of recapturing that money, then it would be affected across the entire shares.
For that time period, but once it's caught up, it'll be reapplied.
And this is actually basically my job. So for the 825, for example, because we do the semi-annual bonuses, what we've been doing is anything that's over and above, because most of these loans are going to be over 8.25%. So what we'd be having is a separate account that can carry forward. If by chance somebody missed a payment and we didn't get paid that month or whatever, we'll have the surplus that's left over from the previous month to continue to make that payment. But then at the end, the biggest thing that would actually affect making that 8.25 is not so much people not making payments, believe it or not, is just the surplus of capital. Because the way it works, it's everything that is being paid out proportionally on how much is in there. If we got a bunch of investors tomorrow and the fund doubled, and we don't have enough.
Get them all the right checks.
All of your money comes in tomorrow. The fund would actually double and you're paying interest proportionately, and if everything isn't loaned out, which is why we have been focusing on taking deposits when we have good deals to fund, because we don't want to be just funding garbage just to get the money out. But in the case that there was somebody who was like not making payments or anything like that, if in the case it went to a power sale situation, because we keep a lower loan to value and things like that, there would end up being like a surplus of funds coming in later, in which maybe the last 4 or 5 months, we actually had one on the administration side that ended up going not power sale, it was sold, but they were multiple months behind, but at the end the investor got everything that they were supposed to. It was just a delay in that happening.
And your primary target, is it an individual or corporations?
For the borrowers. Both.
It is both. So if there's right now it's pretty split, but it's a smaller pool right now, so that number's a little bit biased. But typically we're seeing borrowers that are just individuals. A lot of what we're doing is second mortgages, cleaning up people's debts, so that way in a year from now they can get into a better spot. But it is mostly individuals.
And we do get personal guarantees on the corporations that we lend to as well. So even if they are lending, we're basing the deal on the corporation, there is a real human attached to it as well.
If it's a rental property that just happens to be in a holdco, we still have them attached to it as well, the individual.
Do you have separate APRs for residential compared to commercial?
So we price them differently on the borrower's end. The borrower's going to be paying more if it's a commercial mortgage. Mm-hmm. We're not doing a ton of commercial mortgages in this fund, but the return would be spread amongst the entire investors. So how the entire fund is performing, it gets spread evenly across every investor. There's not separate share classes in the fund as of right now.
It's our regulation that says that we can only have a certain portion of commercial, so we actually have to have most of our assets in residential.
Yeah, no more than 50%, which we don't understand, or we don't have as much experience with commercial deals as we do with residential. We've all been doing mortgages for a long time,
and a lot of that's all been residential. So when you go into commercial, there's different variables. It's not the market that we want to focus on because there's more than enough deals in the residential space.
Go ahead. So 8.25% is a respectable return on the investments, which no one's going to deny that. My concern is by the time you pay your expenses, by the time you make a profit for the company, you're going to have to lend money out at a much higher rate than that, which means that the people that you're going to be attracting are going to be people that have a sort of a risky record or people that are in a risk situation, or else it would be borrowing money from a conventional institution, especially now that the rate of interest is going down.
Yep.
So my concern is that the people that you're attracting to lend this money to are people that cannot get
Regular mortgage.
exactly a regular mortgage from a conventional institution at a lower rate. So having said that, that makes it a little bit of a risky situation. But what is the lending rate that you're asking for, so that we can actually compare this and have a look and see if a lending institution can actually lend that money?
So yeah, I'll touch on that. So basically, like I was going to go into this after, but this person right here, FISA regulation, they work with the Bank of Canada. When I started, Mike Brain will attest to this. You could take a 6-year-old lady who was on CPP only. She had no money on her mortgage, and we could give her $50,000 institutional. Windsor Family Credit Union would usually do it. We could even go to Scotiabank. With B20 in 2016, they came around, and what it did is it decimated the market. There was new rules implemented. Now they want continuity. They can't give the ladies that earn CPP every month. If her ratios don't fit, you don't get approved. But it's 30% loan to value. And we see that her son, he's living in the basement making a little bit of cash, and she can prove that, but she's not claiming it. So Windsor Family declines that loan. A lot of that's happening these days with the government tightening up with the amount they'll do for borrowers. Refis got chopped down to 80%. I used to do 90% refis back in the day. They used to call it compassionate lending. I could go to a bank 2-3 years ago and go to a lender and say, hey, her credit's 550 or a guy, his credit's 550. He just went through cancer the last year, couldn't make his payments. Oh, okay, compassionate lending, we'll approve that. They don't care anymore. Lenders on the AAA side that we're talking about here, they don't care. They're basically saying, well, I know it does suck, but we got to decline that. But what do you mean? It's 40% loan to value. So now we have to go to a more risky situation where they couldn't get approved. And the reason why they're risk rated is because they couldn't get approved by that prime lender. We now have to do it through here. And no offense, you guys all want your return at 8.25. Now the other thing too is where we lend it out. This is a window opportunity. We cannot put the gentleman I'm talking about or the lady I'm talking about in this for 5 years because it goes up, returns great. But if you're over 3 years in a private mortgage, you're going to deteriorate your asset or end in power of sale. So it is a time sensitive issue. Most times when we're loading this with our borrowers, they've gone through getting declined everywhere. Now there's two options there. When they finally get declined everywhere, maybe they land in our office. We're sitting there saying, yeah, I can see why you're declining. You ain't going to the bank. It can't work. Or I can see why you're being declined, but because your loan to value or because the amount of money you're not claiming the CRA, we can do this loan for you. And right now we had just generally about 2 loans in the last week where we did discuss this. We would have put one in the MIC that can't get done. And another one is affordability. It's too tight. So now we have to go to an individual lender and say, okay, listen, you're going to have to take the risk on this, Mr. Individual Lender. So there's a lot of mitigation, but because our government and the interest rates going flying way high, affordability's gone. There's people out there with $200,000 down payment on a $500,000 purchase price, and it's a nice home, it's okay, but they cannot get it because they need, for $300,000, you have to make about 90 to 100 grand a year in income to meet the ratios. Throw in a car loan, they're not even going to be able to afford that. But we'll take it. $300,000 on a $500,000 valued home, we'll take that.
The other thing to mention too is with the deals that we're going to be putting in the MIC, there's usually a story. So, for example, if we're doing a second mortgage for $50,000 to clean up credit cards, lines of credit, things that get them ready to go back to the A side, it might not make sense to break that first position mortgage. If their rate on the first position is at 2%, it might not make sense, depending on the size, to give them a full new first mortgage at 6% with a B lender. So what we'll do is just get them a small second mortgage, do it for 1 year, it's a Band-Aid solution, and then after that year's up, then we refinance the whole thing, or the broker that sent it to us, wrap it all in, and then we pay it all back.
Yeah,
So
we cannot put money on a property without an exit. And that exit has to be realistic. It's gotta be. Because if it's selling the home at the end of it, why not just sell it now? Why go through all these fees? Why just sell it now? But if we can get them in and fix them, I mean, it's sometimes we sit at the end of the day on a Friday and we're pretty pumped because we actually did help out some of our clients. So that's the difference too, going into sometimes.
Regulations. So yeah, like we've touched on a few times already, it's very, very strictly regulated. We're actually, so the administration side, we've been doing that for over a year now, and I am going through our first audit right now, and it's it's the same accounting process for the MIC as the administration side. So they go through everything. They read every single commitment that we issue. They go through every single bank statement that we have and make sure that the numbers that we say are what they are, because it is so highly regulated. We are taking RRSPs and TFSAs, and believe it or not, CRA isn't that chill. So they do.
Very chill though.
They have some regulations that they want to make sure that we're following, and not just taking them out. Like, for example, there's a rule about non-arm's length mortgages with RRSPs. You can no longer just put a mortgage on your own house out of your RRSPs and pay it back at your own leisure, which you could do 8 years ago. And
8 months ago.
had to be insured before 8 years ago. And so, yeah, these are things that they've changed. And obviously, when you're playing with registered funds, when the government gets involved, everything gets extremely regulated. So everything goes through with a fine-tooth comb. They check, like all the accounting and things like that. Everything has to follow the regulations that are set out, meaning particular details about no one person can own more than 25% or have investment of more than 25% of the MIC, the certain amount that has to be on residential properties, and you can own property only if you've foreclosed on it, I think.
Right. Yeah, we can't use the MIC to go buy a bunch of real estate and then own it.
It's the main aspect is this. Government tightens up. A lot of private lenders hit the market. A lot of individual private lenders. In New Brunswick, as of right now, you cannot privately lend to borrowers without being registered with the New Brunswick provincial government. You cannot. You're not allowed. You will get fined as a private lender. This is what's going to happen soon. What happens in our beautiful socialist country is they want to protect everybody. And everybody can sue other people by saying, I did not understand that. Even though you have a whole write-up and it's written down, I understand it, they sign. So what's happening now with the MBLA Act, which is the regulations we actually rule by, FSRA basically is going out, and I would say within the next year, maybe 2 years, you'll have to use a brokerage and have a proper lending institution doing your private mortgages. So if any of you guys are doing private lending on the individual side, you should have an administration company dealing with it, and you should be dealing with a brokerage that sends you that deal. Because if you're caught, I don't think it's going to get that bad where it's like, oh my God, you're going to jail or anything. I don't think it's that. But there's just a lot of suing going on because a borrower can always say, well, I didn't know there was this, I didn't know there was that, and I don't want to pay that mortgage. Right? Was that?
Under duress.
Yeah, I signed under duress. I didn't know. So that's a big fear in my eyes that, if you're doing private lending right now, come give us a call. We'll chat with you and we'll talk to you about regulations. I would say it's probably going to take about 2 more years because Ontario, in our province, is known as the wild, wild west of lending. It really is. And BC keeps calling us that, but I think it's BC that actually is the wild west. But that's just a touch on FSRA. The next slide, Shar will go through it with you. This is just implemented October 11th. It's the anti-money laundering.
So last Friday, week ago Friday, our entire industry got switched up a little bit just to keep us on our toes. Basically, if you are a private lender, you are also included in this new regulation. And FinTrack, what they came through and said, you're responsible. But they won't tell you anything about it. And so we've read a lot of government regulation over the past few weeks, and basically we've paid for software that is taking on to take over the liability to make sure that all the boxes are checked. Things like verifying identification and making sure who you're speaking to is actually who you're speaking to in several stages, not just, yep, we're good, this is you, like it had always been before, or putting that responsibility onto the lawyer, where they would bring in the ID to the lawyer, and that's how they get the money. But because people have been doing fraudulent things and money laundering throughout the years, they've finally cracked down on that.
I actually blamed the show Ozark. It's like the government watched that show and then they said we should do something about that.
And so proceeds of crime, FinTrack regulations, and anti-money laundering, we now have to check sanction lists, which are not just publicly available. So they're like, we'll get in trouble. And an individual as a private lender will get in trouble and can be fined up to $100,000 for lending to somebody and not making a report to FinTrack for a deposit in their bank account that you may or may not have known about because it was your job to check. And so how would you know to search sanction lists? It's just, so we have now paid for software that will cover that does all the searches and make sure that investors are protected and make sure that nobody's getting in trouble.
This new law coming into effect and the new regulations for anti-money laundering are going to protect you as an investor if you do this. We do pull everything on our borrowers now. We run sanctions lists. The sanction list is going to the Canadian government's list to see if they're named in any of these. Okay, we all know who Al-Qaeda is. I'm assuming we do. They actually run a check against that. And then there's the PEP list, which is a politically exposed person. And that could be anybody in regards to how they can take bribery or extortion. These are all checks now, guys. This is stuff that's happening in our market. And I won't lie to you. We're at the forefront of it because our job is to preserve capital, like Sean was talking about before. So these are just things that, I don't want to worry you, but these are things that we're double checking to make sure that your assets are backed because we're an asset-backed security. The two things that we're mainly looking at is the covenant, the borrower. Can they afford this payment? And then the property, guys. This is not any kind of crazy science going on. This is just strictly, is the property worth what it's worth? And is the borrower going to be able to maintain these payments, and how? Our job is to protect you against CRA, liens, and other risks that happen. But our main job is to look at the property. Is it the type residential and our local area? You guys don't have to invest in the MIC. You can do private lending. We will go out and find other investors that want to invest in the MIC. It's okay. At the end of the day, though, my question would be, when's the last time you talked to a financial advisor or sat down with a financial advisor and talked to the owners of the mutual fund that told you what strategies they're doing? What you usually do is talk to a banker, an investment advisor, and they tell you about Fidelity. Now, for the longest time, I thought Fidelity was a guy's name, but it's not. It's actually just this fund that was really good at mimicking stocks and putting it back out and basically moving them around, and they created this beautiful pie. Now, within that pie is a bunch of these companies. And in these companies, there are a bunch of assets, possibly, or they could just be non-asset backed. So at the end of the day, my question to you is, if you have mutual funds, just go home. That's the main lesson here. Go home and check out what you're in. Go home and see what you're actually in and figure it out. What you're in with us is a house. It's probably down the street, 2 doors down here. It's maybe down this way, but it's an actual house. Sorry, I just screwed up there. This actual house in this city where someone needs to get borrowing. Our job is not to rip them off. It's to allow them to keep their home possibly, fix their credit, and move back to a AAA lender. Now, we have historical data on that concept. Our mortgage brokerage slogan, which Sean actually brought out, was your path to a better mortgage. There is people that we have, and I can probably get you data on it, where they've gone private to a MIC to a B lender to an Alt A lender. And finally, we throw them a party when they get into Windsor Family or they get into First National on the A side, and it's a good day. And sometimes it takes 3 years for this borrower to do that, but that's our job every day. I don't know what you guys do on a daily basis, right? But our job every day is to help a borrower and say, okay, here's a solution. And yes, we do yell at some of our borrowers that do not listen. We have to. Shar yells at her borrowers that don't make the payments, and we say, okay, when are you going to do that? Our best bet is to try and mitigate the risk that they're in with a private mortgage, and I would say we're good at it. I would say we're probably the best at it, and we're the only people with a MIC in this beautiful city right now. And I don't know who else is going to come up with one because it's a lot of money to create these things. So just know you are talking to people that work behind the mutual fund and work behind the stock that you're in on that mutual fund. When you're doing individual investing, you're playing the stock market, basically, in my opinion. You're going on one house for $200,000 with one borrower. That borrower gets some kind of disease. Let's call it COVID, right? All right, he gets COVID. That borrower then gets EI and turns around and says, I can't make my mortgage payment. In a MIC, he's spread across, lowering your risk. That's why we can't give you 12, 15%. The other thing is, too, is 8.25 is our target benchmark. We're actually giving out investor bonuses. So if we do end up getting enough returns off of these borrowers, we do issue you guys back the returns that we make. It's not rocket science, you guys. This is just us pooling money to lend out to borrowers that are in need and using that window of saying, okay, we got to fix your bureau. Here's what you're going to do. Most of these loans we're doing are 1-year rollovers. So in 1 year, we have to get you out. So just know, in the end, I would love you guys to invest in this beautiful company that we created. It's called Erie Shores. It is local. We are not going to Timbuktu or Tamascaping, Ontario. I love Tamascaping. It's way north. We are sticking to the local area, maybe as far north as London, St. Thomas, Sarnia, Leamington, Kingsville area, Wheatley. Wheatley, we'd look at it and go, okay, what's the actual loan to value? Is it going to be marketable after, guys? So just know we're taking care of who we put in this, and we're making sure you guys get your returns. But I would say most of our funding is around this area because that's the only area we know. Like, we know this area. I don't know 2 streets off of Bloor downtown Toronto. Could be 4 million. It could be 2.1 million. That's a huge swing as well.
Yeah, we know our appraisers that we work with. We know how they appraise things. We can look at the comparables. I've broken down appraisals and been, especially the ones that come in from out of town. You're looking at it, you're like, I'm just trusting this random person that was hired to know that this property really did sell for this much. And this one really was superior to this one because the MLSs are all taken down. You don't know. And so working locally, you know how your appraisers wouldn't mess around with you, especially when you tell them, we are going to be the investor on this or the lender on this. It's like, I want a conservative value.
So that would bring me to my next question. Based on the number of regulations that you've got to follow, which is considerably more than any kind of a mortgage brokerage, there's a lot of back-end work with me. Comparatively speaking, structure-wise, the 4 of you compared to another MIC, running the same numbers.
So a good direct comparable is a friend of ours that operates a MIC in London. He was around 70 million, and he had him and his partner. So there's 2 guys, and then I believe they had an administrator on staff. It was a very similar size operation. We have an employee as well.
He's about 70 million, and he runs it with him and his other partner.
So you're saying you're capable of handling it?
Absolutely. Yeah.
He'd actually give you a mortgage. You'd be like, man, why is this 2% higher? He's like, oh, that's the Windsor rate.
That's a big reason too. So a lot of these lenders, I know we touched on it earlier, but a lot of them won't lend in Windsor, or they'll restrict the loan to value. We know the market, we're comfortable with it. We are able to offer that need. We're able to fill that gap.
Yeah. You know, I want to touch on something else. So if we do the loan with CMI takes that 3% fee. CMI pays their employees who work out of Toronto, Mississauga. Those workers then take that employee pay, go down to their bar or go down to their restaurant and pay into their restaurants and pay for their products in their areas and their stores in their areas. But if we can consolidate in our own town, and yes, it is a higher rate of interest, but at least it's staying in our city and that people can get paid from this. We already hired an employee to do the back end work as well. That's one more job. I would rather have a ton more jobs in Windsor, and I'd rather us keep ourselves localized to this area to bring it back up. And Sean did touch on that. Like, I'm very passionate about not giving money to Toronto. That's why it sucks, but there's no securities lawyers. So we had to go there. That securities lawyer says, hey, we work with this auditor or accountant. We are going to look for an accountant local as well, because we want to pay local. I don't want to continue dealing out of Toronto, and I'd rather our local investors get paid, because then they go out and spend the money here. It might be that some of you guys make millions of dollars, but you spend it on everything down here, and that when you spend that money and you give those tips, these people that just served us drinks and served us food, they get to go home and make a living. Instead of us, imagine we all had to go travel to Toronto for this event. We'd be paying Toronto people. That's what it is. Or we'd be paying London people if we go to London. So that's my biggest deal here is, why did we create this? To keep everything local, to bring it back to Windsor, to have local investors here. I'll give you another one. We are very compassionate when it comes to lending. There is times where people go behind. Other MICs, for instance, the minute they orchestrate it, but the minute you are behind and do not communicate, power sale. I've had one client, for instance, that tried negotiating, got told by a MIC lender out of Toronto that she was okay for the missed payment, had a lawyer bill for $8,500 for a letter. That is just a slippery slope now. So meaning the MIC lied to her out of Toronto and basically just went and sent her a letter from a lawyer saying $8,500 you owe now because you're in arrears. We tried our best to say, okay, hey man, you're going to be in arrears. Why don't you try and list and sell this, right? And that's I would say where the biggest difference comes in. We are compassionate on that end. Yes, there are rules, but to keep everything local and help out our own people here, that's what we're kind of doing.
Who can even invest in a MIC? So friends, family, and business associates. So that's, some of our friends and family that have invested in it thus far. Accredited investors, which likely could be some of you guys. USC has regulations that ensure that you must meet some criteria in order to be considered an accredited investor. And that's to protect you guys and ensure that, we're not taking advantage of someone who's putting their entire retirement fund into something that they might lose and it would impact them greatly. And then we do, money held in registered accounts, such as we were talking about, TFSAs, RSPs, corporate cash accounts, that type of stuff. So part of our process is to ensure that if, an investor is interested, that they meet some of these criteria so that we are upholding our regulation to the OSC by that logic.
This is going through the process of how you actually go through and you sign a subscription agreement. I actually brought a copy of the subscription and offering memorandum if you want to look at it.
Further questions?
Yes.
How much of your personal money is invested in the MIC today?
So startup costs were in excess of $50,000 in terms of the securities lawyer, financial guarantee with the OSC. And then we all have our own capital invested in it as well. So, we're nearing $100,000 of total investment of our own funds in it.
What rate are you lending out?
Yeah. So with first positions, we're starting at 10%. For first mortgages, we're lending it out at 10%. Second mortgages, we start at 12%.
So is it an interest flow through to us?
Correct.
And your administrative fee comes off another company?
So our management company, Investor Suite, we have our management spread, and it's all in the offering memorandum. We have a 2% management spread, and then the rest goes to the
So
investors.
got to be 10 and a quarter for sure.
Yep. Yes.
Yep.
Got it. Okay.
Yeah.
Okay.
Our target yield will be 8.25%, but not necessarily means every loan is at minimum 10.25%. We might have at 12. We might have some at 8.25%. That gives us that yield.
And the thing is, too, it is in our offering memorandum as well that we are allowed to give back the management fee to make sure that we hit the returns, because we would rather work for free and protect the investors and have them happy.
So obviously, when you lend money, you have to do your due diligence. And you consult your lawyers, your accountants, you get appraisals. What do you ask?
So we will have income verification. If we have any concerns with income, we get an appraisal on every deal. And then we also get the notice of assessment or statement of account for every deal as well. So we got to make sure that there's no taxes owed to the CRA, because they can go in first position, and we don't want to be coming to that.
Yeah.
I'll further it, not to go specific on a deal. So with lawyers, you ask about lawyers. Do we ask lawyers? Lawyers' opinion or a legal standpoint. Specifically, there's a deal that we've dealt with in the past where an appraisal came in. It was kind of a high appraisal. I had to call the appraiser. I talked to the appraiser for about an hour on the appraisal report to ask him, hey, how'd you get to this number? How'd you get to that? What had happened was, it was good. The appraiser was a good appraiser. He's very, very conservative from all our appraisals. We sent it over, but what had happened was the lawyer then got involved, and what he's opinionated on the value himself. He's saying, well, I don't really like that. And it's kind of funny to me how from a legal standpoint, you're now giving your opinion on a value standpoint. So our job is to mitigate properly, saying, okay, here's the appraisal. Now, if that file ever does go back, it's the appraiser who's going to get in trouble for it. But sometimes when you consult a lawyer or you consult other people around it, they're not staying in their lane. They're actually jumping all across the place. I have a realtor who either thinks the market's going to keep going up and he loves this market and he thinks everything's going to go great. And I have another realtor who thinks, oh man, this is the end of the world. You know, it's all going to fall off the end of the track here at the end of the year. Both opinions, very valid. But what is the true opinion? The only true opinion comes out from the professional themselves, which is the valuator, the appraiser. So appraisals, always up front. Is there any adverse effects? Is there actually a pride in ownership? It's great to get a $400,000 value in a property because it's in a good area, but is there crap out in the front lawn? Is there porch busted up? Is there going to be future work on this home that needs done? That's a lot of stuff. So one thing leads to another, leads to another, leads to another. And then you get all these little crumbs, and eventually you end up increasing the rate, lowering the loan to value, or you say, okay, you know what? Risk is mitigated on this. We could lend on this. It's fine.